This tutorial is about trailing stops. We're going to look at what a trailing stop is, explain how it works, and also look at how to add one to an open position. Make sure you watch to the end of the video because we're also going to look at how a trailing stop can be used as an aid to help you follow price swings or even price trends. Hello, I'm Peter Martin with Trading 212. We add videos like this to YouTube regularly. If you click on the subscribe button and the alarm bell icon, then you'll get a notification whenever we add a new video and you won't miss out. So let's talk about trailing stops. Before we get into trading stops though, perhaps we should recap what a stop is. Now a stop is a type of dealing instruction, what we call an order, where you leave a certain price condition. If that price condition is met, then a trade is executed for you. Now a common basic type of stop is just one that's attached to an open position. Basically says if a certain price is met, then get me out of my position at the market price. You close your position. So let's look at that in a little bit more detail just to recap what a stop is. So here we're looking at a detailed trade box for the FTSE 100, the UK 100 index. I've put in my trade size here. I'm going to buy the index and I'm going to put in a stop attached to the position. Let's put that 50 points away. So we can see we get an indication of the amount we're playing with. Let's click confirm buy. So our order has been executed. We can see it now at the bottom of the screen. We bought 5 and we have a stop at 73.15.1, which is 50 points away from where we opened our position at 73.65.1. We can also see this represented graphically on the chart. We have our open position and the stop distance of 50 points away, and we can see that that stop is here, 73.15.1. When we get onto trailing stops, they aren't shown graphically on the chart. This stop now just stays where it is unless we move it or cancel it or our position is closed. So our example of using normal stop order, we bought the UK 100 index at 73.65.1. We want the index to rise, but we put a stop on to protect us 50 points below at 73.15.1. And if the market falls down to that level, then our instruction to deal is carried out. We sell at the market and we close out our position. Now, if we'd gone short, if we'd sold the market, then the stop, of course, would be above, would go higher, 50 points higher, 50 points above the opening level. So your basic stop just stays at the fixed level that you specified for that stop. It'll carry on as a pending order until you amend the level of the stop or cancel the stop yourself, or the market hits the stop, or if the stop is attached to an open position, if you close that open position that the stop is attached to. But a trailing stop doesn't work in that way insofar as staying at a fixed level. Instead, the trailing stop will move according to conditions that you've specified. And basically, the condition is to say that the stop will be a maximum specified distance away from the market. So that effectively, as the market moves in your favor, the trailing stop will move up with it, maintaining that distance that you've specified away from the market. So for example, if you've taken a long position in a certain market and you put a trailing stop 50 points below the market, then it will maintain 50 points below the highest that the market has got to since you opened your position. So a trailing stop won't move further away from the market. If the market starts to move back against you, the trailing stop will stay fixed at that point. But as the market moves up in your favor, then it will keep this specified distance that you've given away from the most favorable level the market has got to. So probably the easiest way to understand this is to look at an example. So let's do that now. So with a trailing stop, first of all, you're going to specify a distance, just as with a regular stop. So let's say, for example, that we want to put our stop 50 points away, and we can see here that you're going long the market. So you buy the market at this level here, and your trailing stop begins, its initial level is down here, 50 points away. Now when the market ticks up to here, then your stop will tick up with it and remain 50 points away. As the market drops, your stop remains at this level, and it will only move up each time the market moves higher than this level. So the next time when it ticks up to here, then your stop would be 50 points higher, and at this level 50 points higher. And then finally we get this, which is the highest trailed level because the market never actually gets any higher than that. So as the market descends here, the stop is staying in its same level, which is here. If the market descends to that point, then you will close out your position. So hopefully now you've got an idea of what a trailing stop is and how it works in a general sense. Let's look at something a bit more specific now. We'll look at using Trading 212's web app to actually add a trailing stop to an open position. So here we have a chart of the US 30 index, the Dow Jones, and we can see that I've already opened a position. At the bottom of the screen we have my open position. I've bought, there's my quantity, and here's the price I dealt at and the current price. And I've got no stop on this position. And we can see up here the level of my open position. Now, to add the trailing stop, it's really very easy. We just double click on this position here and then select this trailing stop tab here. And I put in the distance. So let's say that I put in 80 points away, and it tells me the price that would be basis the current price. And when I confirm, I click on confirm, we get the pending order confirmed. And now if we double click on this again and go back to trailing stop, we can see where our stop is at a level that's 26,000, and it's just moved. It was 58, and we can see that that is already trailing up with the market, which has just moved a little bit higher there. And we can also go over to here and look at our reports and then select orders. And we can see that I bought the Dow Jones. That was executed just a few moments ago. And then here is the confirmation that I put my trailing stop on, and it's still going, that it's pending. And we can see the level of the order was originally 26,056. That was my 80 points away. If we look at it now, we can see that currently it is at 26,062. So it's already trailed up just a few points from where I opened the position. So given that a trailing stop follows the market as it moves in your favor, one of its uses is as a complementary tool to help you when you are following price swings or trying to follow price trends. If you haven't seen it already, you should check out my video comparing trend following with counter trending. And in that video, I pointed out some of the drawbacks, the cons when trying to trend follow. Let's just quickly recap that now, just to explain this point. So when we are trend following, there are a number of drawbacks. These are some of them. You need a very strong mindset in order to pull it off. And then because following a trend for a long period involves coping with these drawdowns. The drawdowns are these losing periods where you're giving back some of the profits that you have been sitting on, and that can be tough. This is particularly apparent at the end of a trend when the position really starts to move against you before you know that the trend is over. So one of the key drawbacks when trend following is that it's so difficult psychologically to maintain the discipline of keeping a position as long as possible, to put up with these periods when the market moves against you. Now, trading stops aren't going to fix all these problems, but it can be used as a kind of psychological crutch in a way to try and help enforce some of the discipline. So let's just look at that quickly. So to illustrate this, let's look at this chart now for a trend following strategy. The time frame along the bottom here might be days. For swing trading, which is a lot like trend following, just shorter than this might be an hourly chart. And we can see that the trend is down, the market is falling. So we might have gone short, let's say here, and we put a trailing stop maybe up here to start with. Now we can see that there are some retracements, the market pulling back, but we want to sort of ride those out and keep following the trend down. So we need our trailing stop to be sufficiently high or far enough away that it doesn't get taken out by those retracements. As the market falls, our trailing stop is going to drop. So it would fall down with the market. Where it gets really tough is this point when the market turns around, because these rises initially are just going to look like small retracements. We don't know the trend is over, and so we're giving back a large part of our profits. What we'd like to do ideally is to let the trailing stop do its job, and the market will come through its trailing stop, take us out, we close our position, but we have still made this profit. So here I am looking at a 4-hour chart of crude oil. We can see that the price has been dropping over the last few weeks, almost 2 months in decline. So if we look at my open positions, we can see that I've already taken a short position. I sold some crude oil. So just the idea here is that I'm trying to go with the flow and sell the market. We can also see though that we've had a few little retracements over these last few weeks. We can see the market rose there about $2.50, and from this trough up to this peak is about $4. Another one of about $2.50 here, and from here up to here is about $4 again. So where we're going to put this stop distance, we want the stop that's going to trail the market. We want it far enough away that it doesn't get taken out by one of these retracements. But we also want to have it that if it does get taken out, that it's going to be something that indicates it's the end of the trend. So let's just say that we decide to have a trailing stop $8 away. So we can just click on here and select trailing stop and put in that $8. We can see that the price will be taking us out at is just below $60 a barrel. So I'll click confirm. In that trailing stop goes in. Not too much thought has gone into saying $8. It really is just for the sake of giving you an example. But now if the market continues to slide, then we retain our exposure. We're still going to be short. The more it goes down, the greater amount of profit we will make. But our trailing stop will follow the market down and enforce the decision that we've made that if the market reverses by $8, then we're going to be out of our trade. I hope you enjoyed this tutorial looking at using trailing stops. If you did, please take a moment to hit the thumbs up button and give us a like. And why not let us know what you think about trailing stops? Are they something you use or something you want to get involved in? Drop us a message in the comment section. We do read each one. But that's all for now for me, Peter Martin and Trading 212. Thanks for watching. I'll see you next time. Goodbye.